Hey everyone, welcome back to Unlocked, where we unlock the secrets of the Australian real estate market. This month, the Australian economy experienced another increase in the cash rate, bringing it to its highest level in 10 years. Given the cash rate is one of the most important factors influencing housing demand and the overall economy, in today's video we're going to discuss what the cash rate is, who decides what it should be, and how it is determined. Plus, you want to stick to the end because we're also going to explain what the latest cash rate decision means for the Australian real estate market and what you can do about it. So if you are interested, smash that like button and subscribe to our channel for more videos like this. And remember, this video is not financial advice. It's just for educational purposes. Always talk to a qualified professional before making any investment decisions. Now, without further ado, let's get started. Imagine you're at a sleepover with your friends. You forgot your pillow, so you ask to borrow one from your friend. Your friend says yes, but you have to give them a piece of candy in return. This is kind of like how the cash rate works. It's the interest rate that banks use when they borrow or lend money to each other overnight. And just like how your friend Candy sets the price for borrowing a pillow, the cash rate sets the price for other interest rates in the economy, like home loan rates. The cash rate can affect how much people want to buy or rent houses in Australia. When the cash rate goes down, it becomes cheaper for banks to borrow money. This can lead to lower interest rates on home loans, making it easier for people to borrow money to buy a house. So more people want to buy houses and therefore prices increase. For example, between October 2011 and March 2022, the cash rate was lowered from 4.75% to 0.1%. During this time, the average price of houses in Australia went up from $460,000 to $790,000. But when the cash rate goes up, it becomes more expensive for banks to borrow money. This can lead to higher interest rates on home loans, making it harder for people to borrow money to buy a house. So fewer people want to buy houses and prices fall. For example, between June 2022 and August 2022, the cash rate went up quickly from 0.85% to 4.1%. During this time, the average prices of houses in Australia dropped from $815,000 to $799,000. It is important to note that there is a delay between changes in the cash rate and its impact on real estate prices. Some estimates suggest that it takes between 1 to 2 years for changes in the cash rate to have its maximum effect. This is because it takes time for people to adjust their behavior in response to changes in interest rates. There are also many other factors that can influence real estate prices too. If you want to learn more about all these factors, check out my recent video, How to Find Positive Cash Flow and Capital Growth Australian Investment Properties. The cash rate is set by the Reserve Bank of Australia, otherwise known as the RBA. The RBA is like a big bank for all of Australia. Its main job is to make sure prices are stable, people have jobs, and the economy is doing well. The RBA reviews the cash rate on the first Tuesday of every month, except for January. On that day, they announce their decision and explain why they made it. 2 weeks later, they release more details about their decision and their outlook for the economy and inflation. When setting the cash rate, the RBA looks at a range of economic indicators such as inflation, unemployment, economic growth, and international developments. The RBA will also consider financial market conditions and developments in credit markets. Think of inflation like a balloon. When you blow air into a balloon, it gets bigger. Similarly, when there is inflation, prices go up. The RBA aims to keep inflation between 2 to 3%, which is considered a healthy rate for the economy. If inflation goes too high, like an overinflated balloon, it can pop. This means things can become too expensive and unaffordable. On the other hand, if there's too little inflation, like an uninflated balloon, it won't float. This means the economy won't grow and people may lose their jobs. The measure of inflation that the RBA uses is the Consumer Price Index, otherwise known as CPI, which tracks the changes in prices of a basket of goods and services that households buy. The latest CPI data shows that inflation was at 7% in the year to March 2023, way above the RBA's target of 2 to 3%. The RBA has been raising interest rates like crazy since May 2022. The cash rate now is at 4.1%, up from 0.1% a year ago. Why? Because the economy is overheating, inflation is soaring, and the RBA is worried about losing control. Let's break it down. The economy is booming after the COVID-19 pandemic, with lots of people finding jobs and businesses expanding. The unemployment rate is at record low of 3.5%, which means workers have more bargaining power and can demand higher wages. But there are not enough workers to meet the demand, especially in construction, which is facing labour shortages. At the same time, inflation is at 7%, way above the RBA's target of 2 to 3%. Inflation means that prices are rising faster than incomes, which hurts consumers' purchasing power and living standards. What's driving inflation? Well, there are many factors, but some of the main ones are the global recovery from COVID-19, which has boosted demand for goods and services. Also, there are supply chain disruptions caused by COVID-19, which have made it harder and more expensive to get raw materials and finished products. Lastly, the geopolitical tensions between Russia and Ukraine have pushed up commodity prices such as oil and gas. Some people also blame the RBA's bond purchasing program for fueling inflation. This was a stimulus measure that the RBA launched in late 2020 to support the economy during the pandemic. The RBA bought $281 billion worth of government bonds with newly created money, which increased the money supply in the economy. This is based on the theory by Milton Friedman that says more money means more inflation. But the RBA disagrees with this theory and says that it's not the bond purchasing program that caused inflation. If you want to learn more about this debate, you can read this article from the ABC. My opinion, it's not that simple. Inflation is influenced by many factors, both domestic and global, and it's hard to isolate the effect of one policy. The silver lining is that inflation seems to have peaked at 7.8% in the previous quarter and is starting to fall. This is mainly because some goods prices are coming down as supply catches up with demand. For example, consumer durables like TVs and fridges, groceries, and new homes are getting cheaper. But some service prices are still rising faster because of high costs and strong demand. For example, rent prices are going up because more people are moving to Australia and there are not enough rental properties available. This will keep putting pressure on rents for a while. The RBA expects inflation to fall but stay above its target until mid-2025. But there are risks that could make inflation worse than expected. For example, service prices could rise faster than good prices in Australia, as they have done in other countries. Productivity growth could stay low, which means that prices can produce more with less resources. And lastly, inflation expectations could change, which means that people start expecting higher inflation and therefore ask for higher wages. This can cause prices to further increase, creating a vicious cycle. The RBA is determined to bring inflation back to target and says that it may need to raise interest rates more in the future, depending on how the economy and inflation evolve. Rent prices are going through the roof because more people are moving to Australia and there are not enough places to live. This is pushing up inflation and making it harder for the RBA to control. The RBA expects rent prices to keep rising for at least another year as the population grows faster than the housing supply. You would think that more people would want to build new homes given the high rents and low vacancy rates. But there are many obstacles that make building new homes expensive and difficult. For example, construction costs are high because of rising material prices and labor shortages. Secondly, interest rates are high because of the RBA's rate hikes, which make borrowing more costly. And lastly, construction delays are common because of labor shortages and COVID-related disruptions. As a result, there are not many new homes being built or planned. The number of building approvals, land sales, and new home sales are all at their lowest levels in years. The RBA expects building activity to drop even more once the current projects are finished. This means that there will be a gap between the demand and supply of housing, which will keep pushing up rents for a long time. On the other hand, the story is different for home buyers. The national average of home prices have slowed down in the last year because of the higher interest rates and lower borrowing capacity. But some areas are still hot, especially those that are more affordable and attractive to buyers. These areas have seen more demand and higher price growth in the last year, and this trend is likely to continue as interest rates go up further. Some examples of these areas are regional areas that have seen more demand for people who can work remotely or from interstate migrants. Secondly, outer suburbs that offer more space and amenities for families. Lastly, inner west areas that have recovered from the COVID-19 slump and offered lifestyle and conveniences for young professionals. Thank you for watching our video on how the cash rate influences demand for real estate in Australia. We hope you have found this information helpful and informative. So what can you do about this situation? Well, it depends on your goals and circumstances, but here are some general tips that you might find useful. If you're a renter, you may want to look for cheaper or shared accommodation options, or negotiate with your landlord for a lower rent or longer term lease. If you're a home buyer, you may want to look for areas that offer good value and potential growth, or wait for prices to fall further before buying. If you're a homeowner, you may want to refinance your mortgage to get a lower interest rate or pay off your debt faster, or use the equity that you already have to invest in other properties or assets. If you're an investor, you may want to look for properties that offer positive cash flow and capital growth, or diversify your portfolio with other asset classes or markets. Whatever you decide to do, make sure you do your research, plan ahead, and seek professional advice before making any big decisions. Okay, that's it for today's video. We hope you enjoyed it and learned something new. If you did, please give us a thumbs up and leave a comment below. We'd love to hear from you, and don't forget to subscribe to our channel for more videos like this. Thanks for watching, and we'll see you in the next one. Bye for now.